Good evening, everybody. Welcome to Frontline Lab's second Vet Talk. Tonight it's my pleasure to introduce Jessie Gray from BBS Tax. As a bit of background for those not familiar with our Vet Talks, at the end of each Veteran Entrepreneur training course, we ask our students what they would like to hear more about that we're unable to cover in the course. There's only so much we can obviously do. And one of the things that's crystal clear to us is the accounting and the kind of work and stuff that you do in the small business is something that we cannot cover. We're not the subject matter experts, so we're always looking for those that are and can help us out with the Vet Talks. The intent is for Jessie to give us a presentation on those issues facing small business, particularly with things like tax compliance. And then at the end, there will be obviously a time for a Q&A session. That's probably enough talking from me to open it, other than to throw over to Jessie. And what I will stress is everybody that comes and does our Vet Talks, we are purposely selecting veteran-owned business. And this is Jessie's business. More than happy, Jessie, if you want to tell a little bit about your background as a military serving member and veteran and how you establish your business, and then jump into your presentation. I will mute me for now and handing over to Jessie.
Thank you. I was an infantry soldier at 8-9 RAR from 2009 to 2015. Got hurt, had to med discharge, needed to find something I could do a laptop in bed on the days when my back didn't want to play ball. So jumped back into accounting, did some more study, ended up getting a job while doing uni for it, and then ended up starting my own business, which I've been doing for a while now. Run all my own clients. Another part of what I do is my old boss bought into a national bookkeeping and tax franchise. So I help them out with some of their overflow clients and train all their franchise tax agents, review and supervise them up to the point they get their licenses, and then provide kind of ongoing technical support as they need it, which basically means my phone's on all day and I just get phone calls off people and just tell them how to do things. Really fun. Also means that because I'm constantly giving the training, I get to constantly relearn all the things sometimes you learn at the start of your career and then forget again, which is handy. And it means that I can basically just someone asks a question, I go this, and this, because I've got to look at it constantly. That part is fun, but it's constantly cycling through new people. And then once they're kind of doing their own thing, hopefully they don't talk to me very much because they're very well trained and qualified now. All right, I'll jump into what we're going to go through. If you have any questions as we go through kind of about terminology or definitions or anything, just speak up and I'll run through it. If you've got questions about how it's going to relate to you personally or a kind of scenario, wait till the end. We might flick the recording off so no one's kind of private details getting caught as I answer those. And then we can chat as long as we need to about that. All right, I'm going to use a presentation I've got here about starting a business. We're not going to go through everything on every slide because it's pretty chock full of information, but we're going to go through kind of the real basics you've got to be aware of as a business owner. Let's make sure that works. There we go. Cool. So lots of pretty pictures, but we're going to cover today is kind of some of the basics. We'll go over structures a little bit. I know Mark might have talked about that during the week or during your courses. Then we're going to look at kind of the things we have to be aware of with our compliances, like our tax and our BAS, the due dates, when it's got to be done, our record keeping obligations, big one a lot of people forget, our kind of responsibilities with government agencies, some of our common pain points, and then how we build strong systems to make sure this all works. Lots of pretty pictures on the slides. Go through the recording, stop, screen record it. I don't mind. It's not, proprietary knowledge is out there for everyone. It's just a basic thing. All right, so I guess we'll start off with the business basics. Terminology and definitions are important when you look at the compliance side because all these definitions are enshrined in legislation and they mean what they mean because of the legislation. So, you might think, oh, this means that. It doesn't. When we're dealing with this, you need to look at the definition under the law. So revenue and income, that's the total money that comes in for your business. That's what you're getting off your customers. Expenses are all the costs you have going out that relate to the business. Tax is any money you pay to the government that comes under tax legislation. So GST, your income tax, your PAYG withholdings, your FBT, and like the list goes on and on. The BAS is your business activity statement. That's a report you lodge with the ATO, and in that report it details GST you've received off customers, GST credits you've paid to suppliers for purchases, any of your PAYGW withholding on wages for your employees, possibly some FBT during the year if you're a big FBT remitter, PAYG installments for your personal tax of the business, and possibly some fuel tax credits. They're the main ones. PAYG, again, that's the tax you withhold from payments to your employees as wages. GST is our goods and services tax, which is 10% on most things in Australia. There are some things that aren't, like health, education, fresh food, and a couple other things. FBT, this one everyone likes to forget, including other accountants, is fringe benefits tax. And that is where if we have a company or trust and we're paying for things from that as basically a personal expense, we then need to pay FBT on it. So we're not getting a benefit without having paid tax, because the government won't let us have anything for free. So we've gone through those couple little basics. I know Mark talks about the structure, and I will now just kind of go through it and relate it back to how that works with what we do. So a sole trader is where, you and the business are the same. A sole trader is basically just running a business personally under your tax law number and ABN. The tax rates that apply are just the marginal tax rates. So it can be anything from nothing if you're below $18,200 all the way up to 45% plus your 2% Medicare if you're over 190, I think it is this year. The risks where you have your liability is unlimited. If anything goes wrong with the business, that's just you, which means you can be sued personally. That's why insurance is so important. The pros, it's real simple and low cost to set up. You literally just apply for an ABN. Easy to set up and run. There's less compliance than some of the other structures, and you get to keep all the profits. The cons, the unlimited personal liability we just talked about. If you make a mistake and your insurance goes, we're not going to cover that, they can come after you and all your assets personally. It can be harder to raise money. You can't really get investors as a sole trader because you have no shares in yourself to sell. You can't do that. You can take loans, you can come up with funding agreements if you want to. It's just a bit more complex. Some banks will tend to not give as much money to a sole trader as well. For some reasons perceived as less credible. So if you're running as a sole trader, some places will go, oh, well, you're not a company, so you mustn't be legit, which is, more their fault for not understanding structures. But it's something, most days I sit here in a t-shirt and a hoodie doing the work. And if I go out and start spouting this kind of stuff, they look at me and go, what are you talking about? So you've got to throw on the polo or the collared shirt, and people sit up and listen then. Where we see this a lot is where freelancers, consultants and small businesses just starting out. We'll also see it a lot with people who are doing work for another business and they don't want to have all the responsibilities and payments that comes with an employee. So they'll tell them, get an ABN and I'll pay you as a subby. A lot of that's moving into sham contracting, which is bad, but that's usually the first way a lot of people start out. Like we see it with like real estate agents, subbies on building sites, that kind of thing. The ATO do love to crack down on that. And they just give us as tax agents more and more compliance issues to deal with to kind of help stamp that out. A little bit backwards here, so I'll jump forward to the partnership. A partnership's just two or more people running a business together. So it's basically just individuals, like as you're a sole trader, working with other partners to other individuals create a partnership. We used to see it a lot with mum and dad businesses. So, your parents or your grandparents, if they went into business, we normally see them as a partnership so they could split the income between themselves. Accounting firms, law firms, architecture firms, a lot of professional services firms used to do it as well. We don't see them a lot anymore. It's kind of an older style with not many benefits. All the income kind of comes in, they take the expenses out, and in the same way as a sole trader, whatever's left over goes to you personally to pay your tax on. And when you have a partnership, it just gets streamed out to the partners in the same terms as the partnership agreement. You've determined kind of your percentage split. If you haven't determined that, it's equal shares. So individual rates apply to your share of the income again. The liability, this gets even worse, is unlimited, but all partners are personally responsible for all the liability of the partnership So if one of your partners goes rogues and signs you up to a bunch of loans and skips town, you're personally liable. One of the reasons it's gone out of favor. The pros, like a sole trader, easy to set up. You basically just apply for an ABN and get a partnership agreement drawn up. You can share skills and resources with other people. So, if you don't know this one piece of kind of your industry, but your friend over here does, and you both do kind of different things, you bring yourselves together, and all of a sudden you've got a lot of bases covered. That's where it's really beneficial. The profits get split between partners really easily. You can't sit there and go, well, we're going to keep this much this year and not that much. It has to be split. It has to go out. The cons, again, unlimited liability, potential for disputes, which happens a lot. Happens in any business when you've got other business partners. And again, harder to raise finance like a sole trader. Like I said, we don't see it a lot now, but if you've got friends in the same industry and you want to start a business, you might consider starting as a partnership because your complementary skills can really help each other. I'll jump over to the last one now, trust. This is all just gone out the window with the budget because the government has just attacked discretionary trusts in a big way. We used to love these for a couple of different reasons. The reasons they've gone after them is because it enables you to do lots of tax minimization legally, because the term discretionary trust means the trustee has discretion to distribute the income in any way they deem fit. So it goes anything from we're not distributing any income, we'll pay tax at 45% on it within the trust, to we'll give it all to one beneficiary, we'll split it between two, we'll give capital gains to one and normal income to another, we'll give dividends to one, and then we can choose to stream just the franking credits to someone else themselves. So the entirety of their income is franking credits, which gets immediately refunded. So you can kind of see from a basic version how good a vehicle they were to do some really fun things. The other part of what we do is we get a trust and put kind of all the operating company entities inside it, and then they pay dividends out of the trust, and you start splitting it out all over the place again. You'd have one company set up just to be a beneficiary of that trust. It would distribute to that, and it would just pay 25% tax. So if you're in the highest marginal tax rate and you don't need to take the money to live, you'd pop it all into that bucket company, pay 25% tax on it, and then you've saved, kind of 22% tax. And you just hold it there and hold it there and hold it there until you need to pull it as a dividend with a franking credit attached. So kind of technical part of it, but that's why the ATO and the government are going after them, because they want everyone paying heaps of tax. So the way trust works is it's a structure where the assets in the trust are held by the trustee for the beneficiaries. What that means is that any of the beneficiaries in the trust are not the legal owner of the trust assets. So if something happens to a beneficiary, they can't be attacked for their share of the assets in the trust. So it gives really good protection. Where we have things like kind of kids and education trusts and setting that up, and I want income to go out to them and this much each year. We hear in the, really the American movies about trust fund kids. That's where trusts are set up because it's not their choice on how they get the money. The trustee determines it. The way they works is all income, again, must be distributed out to the beneficiaries at the end of the year, just like a sole trader and partnership. So you can't retain earnings in the trust itself. If anything you don't distribute gets taxed at 47%, which is the highest marginal tax rate. So it punishes you for doing it, especially if all your beneficiaries are on a lower tax rate. And it was really designed that way to make sure no one was keeping funds in the trusts. The liability depends on the structure. It can offer asset protection, and it's been really good at doing that historically. So the pros, we have lots of asset protection potential. We've got flexible income distribution, and there's lots of estate planning benefits. So if you start a business in the trust and you want to pass that on to your kids as you go, all you can do is kind of have the trustee, if you're the trustee and then you want the kid to take over, you just resign as trustee and appoint, and one of the kids gets nominated to be a trustee. So you can hand it down really easy. Unlike with a sole trader, you can't, hand over the structure, you've got to sell the business components to them. So the trust is probably the easiest flowing one to have that that continuation of service to your family. The cons, it's a bit more complex and costly to set up, because then we have trust setup costs. Legally, a trust must be established by a solicitor. The way accountants get around doing that, well, not get around doing it, the way we do it is we use third-party providers who are solicitors. We give them all the instructions to do it. They create the trust, give it back to us for our client. So basically, we're just giving instructions to the solicitor to prepare it. And that's basically all done online through online platforms now. So it is a bit more costly to set up than a sole trader and a partnership. There is ongoing compliance. So, there are requirements for the trustee to make declarations each year, usually just in minutes you keep internally for the trust. And it's not always the best for trading businesses. Sometimes because of that, retaining your revenue to build up reserves for future situations that can arise. Where we see it really used is for asset holdings, for family businesses, and succession planning. So now I'll jump back to the company, because the company is probably the most significant structure and the most complex. It is a completely separate legal entity from you. A trust is as well, but this one's even further. What that means is that when you set up a company, it is basically treated as another legal person. It gets its own tax file number. It can be sued in court, which means that if you're the director or shareholder and it gets sued, it's not necessarily you getting sued, it is the company. It means if you own your company, you can have a legal relationship with it, which means you can pay yourself wages. As a sole trader, you can't pay yourself wages because there's no legal relationship. As a company, you can. It also enables you, because it's not you, because it's separate legal entity, you can sell parts of it as shares, and you can sell your ownership in it to someone else at some point. Company tax rate is 25% for smaller base rate entities. That slide is backwards. So 30% for normal companies, and big ones you see where, BHP, Telstra, Foxtel, if you get dividends from them, they're franked, will all be at 30%. For smaller base rate entities, it is 25%. The liability is limited, protects your personal assets in a fantastic way. Your liability normally in a company is limited to the amount outstanding on any shares you own if you hadn't paid the full value of your shares yet. So normally when you buy shares in a company, you have to give them $1 for a share. If you want to buy 10, you have to give them $10. They do have set up options where, especially when companies are doing their first round of investment, you kind of say, you apply for shares, say, I want 10 shares at $1 each, but since I only have to give you $5 now, I still have $5 outstanding that's on call. Normally when it gets raised, they'll call it in. If they don't call it in and something goes wrong, the company gets sued, then they can demand that other $5 is outstanding. So very good for asset protection, because you have no liability because you're not the company. And depending on the company, you may have no say in how it's run or anything that happens. The pros: limited liability, more credibility, easy to grow and raise investment because you can sell shares into other people. The cons: more compliance. There's a lot more stuff we have to do. Higher setup and ongoing costs. The profit to tax in the company, which means that then we have just a kind of a little bit of planning on where to leave money or how many expenses to have to ensure we're not paying too much tax that we have to. It's great for businesses wanting to grow. Any business can hire staff, it doesn't matter. But if you want to limit your liability with staff, it's great for that, and attracting investors. So you can then do fun things like stacking, like we have a operating company inside a family trust. So you have all the business running in the company. It does everything there on its own. It employs you, it pays you wages. Then it would pay, if it's got profits and paid tax, we pay a dividend out to the shareholder, which is the trust. And then the trust has to distribute that dividend to the beneficiaries. So once you you can stack multiple times. You can have as many companies you want inside a trust. You can have companies as beneficiaries of trusts, and this is where wealthy people with lots of structures, they would just stack it in and out and then across to another one and just make this huge maze. Companies, you can look up the details of the director, the public officer, and the shareholders on the ASIC register. Cost you $10. You are not private in a company. A trust, there is no registers. You cannot look it up unless you get a hold of the trustee, or I guess apply to the courts to be provided with a copy of the trustee. So you can imagine how good a trust is then for keeping your business private, which is where we used to recommend, let's have a family trust, put your company in it. We'll have another company operate as the trustee of the trust, gives another layer of protection. So if anyone looks up this operating company, all it says is shareholder XYZ Proprietary Limited as trustee of your family trust. The first company they can look up, they can see who the director and public officer is, which isn't too bad, but then they can't go look through at anyone else. So it provided some really great benefits, and you can imagine the real tricky up and down and left and rights and the mazes of structures the real rich people have to hide their ownership of things. So that's kind of a lot of detail real quick. Any questions?
Probably the only question I've got is like charitable entities and things like that. Where do they sit in that structure? Do they just get dealt with as a company that's not liable for tax, or?
You can kind of set up a couple of different structures as charities. It's not like being a charity doesn't necessarily depend on the structure. It depends on applying to ACNC, I think is the body that registers it, and you're looking at more what you're doing. So you can have different structures be a charity. But obviously, because we're talking about businesses here, or anything we do for businesses are for-profit things, I've kind of excluded that kind of stuff. But yeah, right. I've got not a charity, I've got a not-for-profit client. They're set up as a what are they? They are a limited not-for-profit, I think. But it's not the structure that determines if you can be a charity or not-for-profit. It's what you're doing.
Right.
All right, we'll move on to the next one. Limited versus unlimited liability. So let's get back for a second. Where we're looking at what structure to choose, and I think, Mark, you've talked about this with your courses before. It's not just tax benefits and growing. We're looking at liability. The unlimited liability with the sole trader and partnership, your business debts can become your personal debts. Your personal assets are at risk. There's no legal separation between you and the business. So if the business stuffs up, it's you they come after and can sue. If your business can't pay, then your personal assets can be on the line. With limited liability, which is with a company, because it's a separate legal entity, your personal assets are generally protected unless you haven't broken the law in a pretty significant way, like trading while insolvent, or cheating creditors out of payments by paying it out to other entities when you shouldn't. The reason that's important is for the asset protection, and you might all see, or you used to see, when builders would go bankrupt. I'm just going to pick on builders today. When builders would go bankrupt and they get to keep their mansion they built because everything was in the wife's name, or everything's their name, but then the wife's actually the director and shareholder of the company. I'm just an employee that does the work. So if you have someone different, or just that with your shares, to where you've personally got all your assets, and especially if you go set up a family trust and have all your assets in that, and it's got nothing to do with your company or your other trading trust, they can't jump across them. They really want to take you to court and you've done something really egregious, they can possibly, but it's very hard for them to do. So where we kind of recommend, use the standard thing to do, put a company inside a trust that's got another company as a trustee, was for the tax benefits and the liability. And now it's all kind of been blown up a little bit. So we're still waiting on the legislation to be tabled to see how we're going to deal with that in the future. Most important part of structure is you need to do it first. You can't just go, oh, I'm just going to trade as this, and go, oh, well, I need to be a company now, but I've taken out 3 loans with the bank, because the bank won't just go, oh, we'll just change your name and no worries, it's a refinance. And if you open up a new company tomorrow, you have no serviceability in that company tomorrow. you will build it up by transferring the business assets in, but it's something that it's best to deal with it at the start. We do have options to roll over later on, but it's really something you should give some significant consideration to at the start. Limited liability does not remove director responsibilities or personal guarantees. So you'll see now, even if you're a company, lots of leases for premises will have personal indemnities or director guarantees. So if the company can't pay it, they just come straight after you because you said, I'll personally guarantee that. And then director responsibilities, something we'll talk a little bit later on. As a director of a company, you have legal responsibilities under the Corporations Act. And that's where you see things like trading insolvent and people getting prosecuted for that. That all comes under the Corporations Act. I think we'll touch on that in a little bit. Business registrations checklist. So this parts apply to any structure you use. Kind of important to remember, a structure is a structure, not necessarily a business. Because you can have a business under any structure and you can have any structure without being a business. Essential things you need, your ABN, can't carry on a business without it. Your tax file number, you as an individual already have one, but if you set up one of the other entities, you need to apply. A business name, if you're trading under any other name other than your name or your company's legal name, you need to trade. Like I used to trade as Bold Business Services. So I had that business name registered, and then I just went back to BBS Tax because I wanted to. So I had to register the name Bold Business Services so no one else could use it. I still hold the registration in the background so no one else can take it and cause any confusion. But if you want to trade something else and you start it, you don't have the registration, someone needs to go buy it and tell you to stop using it. GST registration required when our turnover reaches $75,000 threshold. Not profit, not taxable income, our turnover. And again, we go back to definitions. That's money coming in from clients. So once we know we're going to go over $75,000, we should be registering. There's a little bit of leeway where you kind of can end up $77,000, $78,000 at the end of the year. They won't come up and you say, pay it now. But, you know, in the next year, if you're going to significantly breach it, that's the point you know that you need to register. PAYG withholding as well. That's required when you start employing staff or if you're in a right structure yourself, and that's a tax we withhold on wages we pay to our staff when we run the payroll. Super obligations, super fun. You need to make sure your super is being paid, and we'll talk about that in a minute. The correct way of doing this, we should choose our structure correctly, register our ABN, register our business name, open a business bank account. It's one of the pain points. We want to keep our personal and business spending separately. Makes my life a lot easier when I don't have to run through and ask you what every single transaction, if it's business or personal. And it gives you a little bit of privacy, so I don't have to see how often you're eating KFC. Set up your systems, your system, your accounting software, your document storage, your payroll, your time tracking. If you use computerized systems, great. If you have a filing cabinet folders, great. Just set it up in a way that works for you. Register all your taxes, so register for GST, pay wage withholding. And from that point, basically, you're ready to go. But you shouldn't run out and start business without having done those things. If you run out and start trading and then give someone an invoice and they look you up and you don't have a registered ABN, they can withhold 47% of the payment, and legally they're required to. So imagine you go out and do a week's worth of work, give them an invoice of $10,000, they look it up and go, hey, you're not registered. And then they just pay you $5,300. And they're supposed to pay the rest to the ATO with your name. Not ideal. With companies, I have a couple other things. Before you set up a company, you must apply for a director ID for all directors. They must have one personally. You can't even process the application for a company now if they're not on there. The screen will just stop and cycle. Asset company registration is a little bit different when you apply for a company that's done. Depending on your business, you might need some license and permits, like hospitalities, businesses need them. If you're going to operate from premises, normally you need a DA on the premises to do it. Could be some industry registrations, like I need to be licensed with the Tax Practitioners Board. I've got an IPA membership because I'm an IPA member, and I tell people I'm an IPA member, I must have my IPA Practicing certificate, CA and CPA are the same. So there could be different industry registrations depending on who you are a member of and what industry you're in. Work cover, if you're employing people, you need work cover. Payroll tax is a state tax. Each state is different. That's not one that hits you straight away. For example, in Queensland, I think it's $1.1 million is the threshold, or maybe $1.3 million is the threshold before you have to pay payroll tax, but you must register the first time your weekly wages go over $25,000. FBT registration is just a thing you need to do if FBT applies. Trademark registration, Mark, I know you've talked about that, so I'll leave that one alone. And director ID I just talked about. Commonly missed items, no separate bank account, not registering your GST, choosing the wrong structure, not setting up your payroll, withholding and paying super, paying super in the wrong way, that can bite you, and using an expired business name. All of a sudden you'll be told to stop trading under that name, so it's not your name anymore. All right, the big four. This is kind of the biggest thing where we see people get hurt money-wise, so I'll spend a bit of time on this. GST is our goods and services tax. It's 10% tax on most goods and services you sell. And the way it works is you work out what you want to bill your client for. Let's say I've done a job, I want $1,000. I then have to add 10% to it to make it $1,100, and I give the client that invoice. They then pay me $1,100. $1,000 that is mine, $100 is the government's. The way, so that's GST collected, and we should keep that separate and not spend it. Our GST on purchases reduces the amount of total GST we have to pay to the government. So you'll see on your invoices when you buy products or maybe some services, it'll have the amount and it'll have a GST there that you've paid to them. And you get a credit for that, for what you have to remit to the government. So let's say that, $1,100 invoice I've issued, I had to buy $500 worth of materials from Bunnings, and they have to apply 10% GST to it. So I have a bill from Bunnings for $550. $500 that is expenses, $50 is GST credit. So all up, I have to pay the ATO $50 of GST. The other $50 Bunnings pays them. So they're still getting the $100. It's just in two different ways. And as it keeps going up the line and more people buy, they'll eventually get the same amount of money, just broken down over the different GST remitters. Does that confuse anyone? Good. We report all this in our BAS. Most small businesses get to do their BAS quarterly, and it runs from July to September, October to December, January to March, and then April to June. I guess that goes right into the next one where we've got our BAS, our business activity statement. This is the report you lodge to the ATO, showing your GST, showing your PAYGW withhold on your wages, and showing your PAYG installments. The due dates for those are the 28th day after the end of the month for that quarter. So for September, we've got 28th October. December, we've got 28th of January. You automatically get an extension 28th of Feb for January because it's over the holidays. March, we have 20th of April, and June, we have 28th of July. Now, if you are doing it on paper, it is those dates. If you submit electronically, you get an extra month extension. So you end up on the 28th day, 2 months after the end of the quarter, which is really handy, except for Feb, that one stays. Having said that, if you have a bookkeeper or accountant doing it for you, and you wait until, let's say, the 25th of the second month to give it to them, that's not getting done and lodged on time. There is no way you're rocking up going, here you go, do all my stuff for me immediately now, or it's late tomorrow. You'll go into the workflow and it's your fault for being late. Our pay-as-you-go withheld, this is tax withheld from our payments to our employees for wages and salaries, and sometimes a couple of contractors, they fall into it there as well. There are set tables that determine how much you need to pay on this, and there is legislation that sets that out. So you can't just go, I'm going to pay myself $10,000, but I don't feel like withholding anything on it this time, so I'm going to vary it. That makes you in breach of the law that applies to that. You must use the tables unless you have applied for a variation not to. we pay quarterly again with the BAS. If you go over, I think it's $25,000 of PAYGW in the financial year, they'll bump you up to paying your PAYGW monthly. And then you'll have an installment activity statement to lodge each month. And then the month that the BAS falls due, it's just rolled into the BAS as well. So you could end up with 12 lodgements there if you're paying enough wages. FBT, we talked about it before. This one bites a lot of people as well. So this applies to if you're employing people and providing with certain benefits. The biggest one's usually a motor vehicle owned by your business. Then you're going to pay FBT. Other ones are entertainment, paying personal bills. It really bites kind of where we have a company or trust set up and we're the employee, and then we bought our motor vehicle within that structure, and then we're using it personally. And again, like I said before, we have to go back to the legislation and look at definitions. Personal use is taken as any day that the vehicle is parked where you live overnight. Doesn't matter if the business is also run from there. If it's overnight where you live, it is available for personal use and it falls under FBT. So obviously the way around is to have a separate business premises where the vehicle stays, or to have an exempt vehicle. So for example, me, I've got my car through my company. It lives here at my house because I operate my business from home. So I have to pay FBT. Now FBT, I'll focus on the car, so that gets most people. They're basically looking at the taxable value of the benefit, which is what it cost that the ATO determines. And that's determined by how much it was worth. They have notional depreciation of 25% a year. They have notional interest on it, the ATO's rate. Then anything you spend on it for fuel, repairs, servicing, you make modifications, that you've got insurance, that, and the rego. Then they look at the actual business use. And this is where you need to keep a logbook for 12 weeks. Keep it 12 weeks continuous. It's valid for 5 years, and that determines your percentage. So, if I have 30% personal use, means 87% work use. Then when we work out the FBT, I've only got to pay FBT on 30% of that taxable value, because that's where the personal use comes in. It starts to get complicated. You're not going to understand the technicalities of it, but that's where we talk about having a good accountant. Income tax, I mean, we're all going to know what income tax is. There's our rates there. You can look at pretty easily. That's the tax we pay in our personal income. Our personal income we run a business will either come from directly from the business for a sole trader or a partnership, from our wages if we're in a company or a trust structure and paying ourselves an employee, and any distributions from our trusts as well. I kind of went through the understanding GST before, went through the BAS before. STP, this is a big one for payroll. If you're employing people, you need to lodge through STP. It's now a requirement, has been for a while, which means that each time you run a pay event, whether it's weekly, fortnightly, monthly, or quarterly, you must lodge it to the ATO, and they have a running update of how much you've paid everyone, how much PAYG you withheld, and how much super you should have paid people. That links into the super. Super, until 30th June this year, you had to pay each quarter. It has changed to payday super, which means that when you pay the wages, you must pay the super at the same time, because you have 7 business days from the day you tell the ATO you pay your wages with the STP for that to hit the employee super funds. 7 business days. If you pay wages on a Monday, you've got till the following Wednesday, and the money must hit the super fund. And the super fund reports back to the ATO and lets them know if you haven't. And so what that means that all my clients have kind of since January been saying, we're going to start doing this now. So we're just in the process. If you're setting up a business now, it's just something you're going to do now anyway. There are penalties for not paying super on time. You'll get charged an admin fee. You'll get charged interest that the ATO, that the employee should have earned on the super in their funds. And then you'll get you get charged, I think it's another percentage of the shortfall in interest again. And some of them are adding up to basically double what you should have paid. The other really fun part is if you pay super late, you don't get it as a tax deduction. So I've seen cases where people paid $100,000 of super late, and all of a sudden, they've had to pay the $100,000 in super, but they paid it late every quarter, and now it's not a tax deduction, so now they're paying an extra $25,000 in tax they didn't have to. Plus, they got penalties and interest as well. Super's a big one that the ATO chases and the government focuses on. FBT, talked about it before. I'm not going to go into much more detail, but if you have a company or a trust and you buy your vehicles or pay for holidays or pay your rent or anything else straight out of your company or trust, you're probably going to be liable for FBT, and you need to get your accountant to deal with it. If you just go, no, doesn't count for me, it does. And if you never lodge an FBT return, the ATO can go after you forever. There's not really a time limit on FBT until you lodge an FBT return. And it's something they do. The FBT's compliance team used to look at kind of the returns, go, okay, you're saying this car's 100% business use. Here's photos of you at the footy field, at footy training after work. Here's photos of you up at Bribie Island, four-wheel driving in a camping ground. Explain how it's 100% business use. And they nailed people in a big way a few years ago with that. So it's definitely something you need to think about. But have a good chat with your accountant about it, because I can't cover it at the time we got here. Our due dates, we kind of went through them before. I know we're getting a bit tight on time, so I'll run through it. The BAS, 28 days after the end of each quarter. Extends out another month if you do it electronically. Super, each time we do a pay run. Income tax, if you're doing it yourself or you are in trouble for not lodging on time in previous years, 31st of October. If you're through a tax agent, we get a concession out till the 15th of May. So we get a fair bit more time. And that is generally 15th of May. For companies, it has to be lodged and paid 15th of May. For individuals, has to be lodged 15th of May, then you get your notice of assessment. I lodged a couple on 15th of May before, and we were told it had to be paid by, I think, the 6th of June. FBT year is different. The financial year ends on 31st of March. FBT return and payment due 21st of May. If you're using a tax agent, you get till the 25th of June. ASIC reviews are just for companies who have a company registration managed by ASIC. You have to pay to set the company up. And then each year on that date, you'll get your annual review. You'll have your registration fee again, for currently it's $329. And it'll come to you on the day you set up the company. You have 2 months to pay that. If you don't pay it on time, they'll hit you with late fees, and they never, ever, ever remit the late fees. And if you don't pay within kind of 12, 24 months, they will cancel your company. And if they cancel your company, you can't lodge any of your BASs, it won't show up on any of the searches. We've seen people keep working and hand in a bill, and someone's come back and going, hey, your company no longer exists, and bank will freeze the bank accounts, can't access anything. Really important one. Record keeping, general rule is 5 years. Some are a little bit longer. I think employee and super records are 7 years. Most bad stuff is 5 years. If you're using accounting software like Xero, it's got a great expenses app. You can take photos of the receipts and it will automatically put it into Xero for you and do most of the work. HubDoc will do the same thing, bit more to set up. If you just have a paper system, put stuff in a folder, but you need to keep it 5 years. There's no excuses. If the ATO comes along and audits you, which they can do, you go, I didn't know I need to do that. Too bad. You as a business owner, it's your responsibility to make sure you understand what needs to be done. Another fun thing with this is for your income tax, you must keep all records to do with that income tax year for 5 years afterwards. So when you're looking at capital gains and working out capital gains on houses you bought 20 years ago, that means I have to have the original contract, stamp duty documents, building and pest, the possibly solicitors and conveyancers fees. I need to keep all those documents until the year I sell it. And then the tax return I lodge in that year, that's when the top 5 years starts from then. So I've had people come in and go, I don't know that stuff we did years ago. Why would I need it to work out a capital gain? So lots of stuff. If you maybe think, oh, I don't know if I need to keep this, just ask. Your bookkeeper and accountant will know for sure. Just ask, stick it somewhere. Better be safe than sorry, because it can bite you. ASIC just for companies. You register your company with ASIC, you pay the fee. Each year they'll send you a renewal notice and you have to pay it. Don't pay it on time, they hit you with a late fee. They hit you with enough late fees, they will deregister your company. All right, the ATO. What the ATO expects, they want you to lodge on time. They want you to lodge correctly. They want you to keep good records. They want you to pay your employees correctly. They want you to separate your business and personal spending. Sounds funny, but I have seen, not one of my clients, I've done a review on someone's work, and I've seen a builder who wasn't doing work that year, but was renovating their house and was claiming all the renovation costs as business expenses. Completely separate. Understand your numbers. I know there's a lot of people who just want to know how much tax they got to pay, but if you don't understand your revenue, your expenses, your cash flow, if you're kind of trending upwards, if you don't know your numbers, what you're doing, you're not going to be able to grow your business or manage it correctly. Last one, ask for help early with us, with your accountants, with your bookkeepers, your solicitors, with the ATO. If you engage the ATO early because you're having trouble, they will help. If you just leave it and don't do anything, they're not going to want to borrow it. Some of the things the ATO risk behaviors are is ignoring letters. The ATO will send you letters saying, hey, we think you forgot this, or deal with it now. If you ignore it, it gets worse. Using your GST money as cash flow. Like I said before, when you charge a client, part of that is GST you have to pay to the government. Put it in a separate account. Don't spend it. Don't use it for cash flow because it's not your money, for one. And the second part is you go, oh, I'll just do this now, and then next month when it comes in, I'll catch it then. You won't. You won't catch it then. You'll just fall behind. You'll constantly just be having to work to try and catch up, and you're just kind of grasping at water. Falling behind in your bookkeeping, if you're up to date with your books, then your numbers are right, and you can use that to really kind of strategize and work on your business better. If you don't do any bookkeeping for months and months and months and look at it, you're not going to have a clue. The numbers aren't going to be right. Not setting aside your tax is a big one. As you have money coming in, if you can kind of work out what your taxable income will be during the year, put money aside. Again, if you go, oh, I'll just pay it when I'm done, I don't need to worry about it now. So here's a business owner. No one's setting aside tax anymore. There's no PAYGW if you're a sole trader. It can bite you. I've seen some people with $50,000 tax bills with not a cent in the banks. They spend it all. So if you have trouble with kind of really separating, you see the business bank account and go, it's 100 grand and I've got 100 grand to spend. And you're one of the people who can't go, but 50 of that's tax, so I can only spend 50. Get another bank account, hide it in there so you don't see it, kind of outside, out of mind, you won't spend it. Paying super late, another big ATO one, and mixing your personal and business expenses. Again, your responsibilities, is that the same one? Nope. Lodge on time, keep good records, pay your employees correctly. You don't want to end up at fair work hates employers. Separate your business and personal spending, ask for help early again. Basically the same stuff, but it's on you to do it. We're not going to worry about that one. Common pain points. So I've kind of prattled on about this as we've gone, but starting up a business, there's things we see that can hurt you as a pain point, and they can make things harder for the professionals as well. Ignoring the ATO letters, so not engaging with someone to fix your problems as they occur. Again, falling behind your bookkeeping, using your GST money, or your money that should be going to make your BAS payments as cash flow or personal spending. Leaving your super and payroll too late, so it's not paid on time. All those things are kind of the ones we really see hurt people. Another one doesn't hurt too much, but it's just something that happens. If you just go on and slog it out for 60 hours that week and you get home on a Friday and go, I'm going to do all my invoicing on a Friday, have the footy on in the background. And then you get home and go, bang the footy on and go, I don't want to do it today, I'll do it tomorrow. Or, I just want to enjoy the weekend, I'll definitely do it next week. And then next week rolls around. No, I'm working 12-hour days again this week, I'll do it on the weekend. And it's just a cycle, it never gets done. One of the big things I tell people to do is pick a time. Doesn't matter if it's 5 or 10 minutes each day, every Friday arvo, it's on a Saturday morning. Pick a time and just do it. Make it a habit. Like we used to all hate doing PT at 7:30 in the morning on a Monday morning after going out on Sunday, but you had to do it. Pick a time, just do it, and it's done. and you'll thank yourself for it because all of a sudden I'll do it next week. Turns out I haven't done it for 6 months. Oh crap. And that will happen. I've seen it happen many, many times. Building strong systems. Have clear processes. It's not going to count too much for the people. Good records, right people in roles is kind of, your external support people. So your bookkeepers, your lawyers, your accountants, using smart tools and automation, get as much of it going through to get rid of manual processes. It's fantastic. Measure and review, track your numbers, track your business's health. If you're doing that and you spot something happening early, you've got a chance to fix it. If you leave it and it gets away from you, sometimes there's nothing can be done. Fun one for building a fresh support team. Mark, we talked about this before, and I think you do talk to people about it in your course. As a business owner, you want to be working on the principal tasks of the business and not trying to do all this stuff. And anytime you spend not doing that, is money, is time you can't bill for. So, you want an accountant and a bookkeeper. They can sometimes be the same person. Payroll specialist, not necessarily do the payroll, but more like a HR person if something pops up with. There's a bunch of places out there who do a great job on either a plan basis or just ad hoc services, and that can really help when initially setting up contracts, or maybe you've got some tricky award interpretation, or you're taking to Fair Work. A lawyer, you always need a lawyer no matter what, like for the simplest things, like the second you get a lease for a commercial premises, you need a lawyer and an accountant to provide a written report back to the leaser that you've seen them. An insurance advisor, great again, and a business coach and mentor. They're worthwhile if you think they're worthwhile. A lot of time business coaches are really great psychologically, and they can go through lots of different things and help you plan and stuff. But I mean, like numbers planning and that kind of stuff should be back up over here with your accounting, your bookkeeper. If you like the motivation they provide, or they're giving you like steps on growth and sales funnels, that kind of stuff, absolutely great. Same kind of thing we just went through. Tech stacks, not going to be a huge deal for you guys. Accounting software, RFN Xero to everyone, it's great. HubDoc's owned by Xero, so you usually get a free subscription to it in there, and that just catches all your invoices, receipts, and paperwork, and then puts it into your Xero file or into another file like Dropbox. I use Google Drive, I love it. Deputy is kind of a rostering system that if you have kind of complicated rostering and payroll, it's great to use. And then depending on the industry you're in, there is just hundreds and hundreds of options. The other things you'll get is like payment gateways on your invoices. People able to pay with a credit card online on a link. If you need signatures on documents, e-signature. If you're doing like sales or lots of lots of different client things, you need a CRM and a sales tool. And then your communication. Everyone needs communication. I use Gmail for all of my stuff. I think it's a great system. Cash flow and tax planning. Big one, you definitely need your tax agent account to do this with, because even though you think it might be a tax deduction, there's not much common sense in tax. So I know I've gone over time, Mark, and that is about the end of my slides. Lots of slides there as usually for a bigger presentation. But you can see there's a lot you've got to think about when you're starting up a business. It's not just, I'm just going to start and do it. It's great. Like I've just data dumped 26 slides and basically 50 minutes of gibberish into you. You're not going to understand everything. The point there is there's a lot to know, and it takes a while to know it all. And even some of these things can be real technical. And I've seen plenty of people in my industry who should know better getting it wrong as well. So when we go back to building the team, it's important to have someone you trust, who's reliable, has a good reputation. Because if you don't know it and they tell you it, and they're wearing the nice shiny suit and they got out of the expensive car, you might just go, oh, yep, he knows, it must be right. You've also got to kind of have an understanding to know whether to call them out or not. All right, I've gone way over time, so let's jump into questions if we have any.
Hey, don't worry about the time limit, Jesse. I can keep it on for another 15 minutes for the guys' question. just for everyone, just to reiterate, the recording will be available probably tomorrow. We'll put it together and send it to you and all of those that registered as well. Interestingly, Jesse, some of the things I picked up on the bottom of it, there's a lot of good bumper stickers and a lot of good points there. One that resonates with me straight away at the moment is what works today may not work tomorrow. If you don't need an example of that, you can have a look back at the budget from last week. That'll stuff you around. You heard us on the course, all of you that have been on the course recently. I will sing till the cows come home. When I first set up all of my businesses, and my most recent one, the first two people I got in my team was a decent lawyer and a tax accountant, and I mean decent. You need to find someone by reputation, do your due diligence, research on them to make sure they're the right kind of people for you. I did the highest level of contracting in DMO, but I'm not a lawyer. I refuse to accept that I'm a lawyer. I'm pretty smart at it, and I think I know some shit, but I'm going to get a lawyer that's qualified as a lawyer whenever I'm dealing with a legal document. And I was never an accountant. That's why I'm always happy to have an accountant. So I think that was great advice, a lot of stuff there. And the other good thing with a tax accountant, like we mentioned last night, they will help you with tax minimization. If you choose to go the other path and try tax avoidance, the road is not paved with gold. So please use a tax accountant for those kind of reasons. So I'm extremely grateful for Jesse's time to put that. And again, those slides, Jesse, I think will resonate with a lot of people in slower time when they look through them. But Matt, Steve, Ian, it's 7 o'clock, but happy to go for another 10 minutes. If you want to ask questions, general ones to Jesse now, go for it. If you want to ask ones that are not recorded, let me know. And in a minute or two, what we can do is I can stop the recording and you can stay on and ask them that way. So, gents, any questions?
Thanks, Jesse. I've got a question. Just with regards to subcontractors, and are they eligible for super payments at the moment?
Okay, subbies is a fun one. Where I talked about the sham contracting before, that's where lots of places, they all kind of got together and went, oh, we don't want to pay, these entitlements. How can we get out of it? And then someone went, oh, if they get ABNs, they're a contractor and they've got to deal with it themselves. And so they made all the employees become subcontractors, just paid them a little bit of a higher hourly rate. And then not a lot of them realize, like, that's cool, but now you've got to do your bookkeeping, you've got to do your accounting, these other things. And actually that you're not getting super, and that rate you're actually worse off under. But they kind of jazzed it up a bit. The ATO doesn't like it. One, because you lose the protections. The government doesn't like it for those reasons as well. The other part of it is if they're a subcontractor as a sole trader, if there's kind of these rules we have to go through to determine if someone is, and it flows through to having to pay the super. If they're basically treated as an employee, so you can direct them how to do the work, they can't get someone else to do it, so they can't have one of their employees or subcontract it out. They charge an hourly rate. They don't have to provide tools of the trade. They're not required to fix mistakes at their own cost. Then essentially they're an employee for superannuation purposes. Okay. So where we're looking at stuff like that is, I have seen like kind of process workers, or people just like sitting in a computer running processes, and then each week they give them an invoice for the hours they work. They're sitting there in the employer's premises on the employer's equipment, doing the work directed to that's been given to them. When they talk to people, they talk to them, as a representative of the employer. That's 100% sham contracting, and you're required to pay super on the total of their bill. And you still got to run it through a super clearinghouse. So now we'd have to do it through, STP. You're not declaring their wage, you're saying this is how much super I'm paying them. Then to get around that, people went, oh, we want you to set up a company or trust. So you'll see a lot of the building subbies now, like, we'll only deal with you if you're a company, because that circumvented that. But then part of it is, well, are you really running a business? Do you actually, and this part comes back to what we call PSI and the tax returns, which is personal services income, which is you can set up a company or a trust if you want, but it's essentially just you doing the work. You're not allowed to distribute that money out to other people. You're not allowed to leave it in the company at a lower tax rate. It goes to you as PSI, and you get taxed on it in your tax return at the full marginal rates. And it comes back to that part where essentially I'm employee through a structure. And so I should be taxed as an employee would, because otherwise, and what they've just done with trust in the budget, they're looking at it going, it's really unfair. So very long version of some subbies are liable for super, and it kind of depends on the relationship and what's actually happening, the facts of the case. It's gone through the courts a million times. And another part of this is one of the pain points where I said, definitions are the definitions given to by that specific legislation we're talking about at the time. And definitions are different across different legislations. So you need to be aware of what it is for what you're specifically talking about. If we have kind of that definition of something and we go, okay, it's this, and you go, these are the rules, and you go, read down the rules, oh, this one. So if I do that, then it doesn't count. And you kind of cherry pick and graph onto that one and kind of hang your whole case on that. But I needed to read all 10 points. And then I said, I need to go to the next legislation. I need to read all those 10, and I've got to put them all together to work. And people will just cherry pick at the first thing that makes them think they can do it. And that's where all this sham contracting came from. You'll see it at the moment. I don't know how many of you guys are on the socials and what your algorithms are like, but I see a lot of the people popping up saying, set up companies in Dubai, you pay no tax. And if you spend half the year in one day out of the country, you're not a tax resident, pay no tax. Absolute lies. They have cherry picked one part of the are you a tax resident testing, and there's about 6 tests to it. And they've just grasped onto that and they're using that. Either incompetent, lazy, or shitty accountants are processing their returns for them, or they're the ones telling them to do it. And there's a lot of people who, if they got audited by the ATO, will probably cry for 2 years straight. So yeah, one of the biggest things I can do is, if you're going to kind of do research on something, read everything, then read it again, because cherry picking on one thing, usually you'll get the result you want, but it's not the result that should be happening, and it can be ripped apart. And then if you go see, a lawyer, a booker, account, they say, no, you can't do it. And you start going shopping, you find one who says, yes, we can. If it's 1 out of 5, it's probably a good chance that one's wrong. Unless they can show you specifically all the legislation, do a tick and flick through it and go, this is where we are, and give you a really good, letter about why it works. Otherwise, you're basically just shopping to get the result you want.
Right on, thank you.
No worries. Another part that goes on to that, if you go out and go get quotes for work and, hey, I want this done, and then you find one who's a whole lot cheaper than everyone else, pretty good chance the work's not going to be good. Another thing to watch out for. I mean, it's the same everywhere. You get quotes, you go to the one you want. I'm definitely not the cheapest person out there. I'm pretty good though, and I'm pretty thorough. But I've had people, when I've given them a quote, kind of eyes light up and say, oh, what's the name? So they do it for $300. I said, that's cool. They're definitely not doing the required checks at that amount, because they'd have to work 18 hours a day to be able to make a livable income doing that.
Thanks, Jesse.
I just got a real quick question about and it's probably framed around a micro or startup business when you're not going to be going over that $75,000 threshold for purposes of GST. Do you still need to charge people GST even though you're not registered for it, or is that not right?
If you're not registered, you can't charge GST.
Yeah, that's what I thought. And I was worried because the first couple of invoices I sent out, I actually added GST on it, thinking everyone that gets an invoice has to have GST. And then I went, holy shit, I think I've done that wrong. So yeah, I'm going to fess up to the tax, the ATO this year, because it's like, I'm talking like a couple $100 or something in the total. But yeah, I was wondering about that, because one of the people I dealt with that I tried to send an invoice to with no GST, and I said, I can't charge it. They said, no, we have to pay it. And I went, I don't think I can charge you for it. And I got confused then. And I went, I don't know what I'm meant to do.
And that's one of the fun things where business owners understand how to run and do the principal work of their business, maybe haven't done all the GST legislation training to know that. And you do get people who go like, oh no, we have to pay GST because we're GST registered. It's not about if you're buying something, it's not about your registration, it's about the seller's registration if they charge it or not.
Right.
So there are cases where, you'll buy things and there'll be no GST on it because they're not registered GST, means you don't get a GST credit. And that's where you've got to be checking the invoices. In that case, if someone had looked up your ABN and seen that you were not registered with GST, they've just got to pay you the net amount. So they don't have to pay you the GST.
Yeah, good.
So a couple of different things happen there. They can not pay you that. You can amend the invoice and go, so sorry, wasn't supposed to GST on it. It stays the same amount. But you said, so sorry, not supposed to GST, and the net amount is the right amount. Or you backdate your GST registration and pay what you've collected.
Yeah, no worries. I would love to think I'm going over $75,000, but I won't be. Yeah, hopefully that's the goal. The only other question I had about, I'm thinking about asset protection, obviously, and the protections of the company structure. If you're if you're just a solo operator, are you signing yourself up to double taxing with a company tax rate and then having to pay yourself with a PAYG tax added to whatever you're doing? Do you end up, I suppose, throwing yourself on the sword to protect your assets, but ending up getting double taxed on everything that you do?
You don't get double taxed. So the way it'll work is, where I've said before with separate legal entities, that means when we have a company, the company gets all the income, has the expenses, it comes up with what's called profit in the accounting books. And profit and the taxable income you're recording in tax return can be two different things, because accounting treatment like depreciation, your super expense, a couple other things, if we have outstanding accounts receivable at the end of the year, we haven't received the money, we can reconcile those out so you don't pay tax on money you haven't received yet. And when it gets paid the next year, you'll catch it. So there's a bunch of different things that can mean that the profit we see on our books is not the same as our taxable income we'll pay tax on. And it can be the same and it can not be. So when we get to kind of our profit, let's just say it matches our taxable income, a small base rate entity business or company, which is what most of us would be if we had one, it pays 25% flat rate tax on its taxable income. Now, if you are working as an employee in your company and you're getting paid wages and withholding tax on it, remitting in your BASs, that tax is taken care of for your income for employment on your tax return. So that's sorted out there. And that is an expense of the business, so it will reduce its taxable income down and it will pay less tax.
I see. Sorry, I wasn't thinking about that aspect of it. Yeah.
But then the other part of it is then if you are the shareholder and you pay yourself a dividend, which is your share of the profits of the business, you don't have to pay all the profits out. You can choose as a director of the company how much to pay, and you're supposed to choose to pay as much as leaves the business in a safe position. So you don't try to gut it all out and then not be able to pay bills in the future. When you pay yourself that, it comes through again to you as taxable income. If the company has paid the required tax on it, then you get the franking credit on it too. Now, where there can be some top-up tax or possibly a refund is where the rate that the small business base rate pays tax, that's 25%. So if you're on a marginal tax rate of less than that, so $18,200, there's nothing, then it's 19 cents up to $45,000. Above $45,000, I think it's 30 cents at the moment. So once you hit $45,000, anything above that $45,000, you need to pay 32 cents on. So if we have let's say we paid ourselves a $45,000 wage, we would have had enough tax withheld to cover that. But then we're going to pay ourselves a dividend as well. So let's say we're going to pay ourselves a $7,500 dividend that's had $2,500 of tax paid for the company. So we get a $2,500 franking credit. We've got another $10,000 of income, which $10,000 of income, our tax is $3,200, but we've had $2,500 paid already. So we've got to find $700 of top-up tax. So that's where it seems like double taxation. It's not double taxation, it's just making it up to your marginal rate. But the flip side is if we were below that $45,000 and paid ourselves a dividend and didn't go over the 45, we're getting a credit for 25% of it, which we get refunded on.
The other way,
yeah. But that's one of the fun things where we have to do tax planning on it, because you have all this money and then go, oh, I want to pay myself some dividends, I'm going to pay a massive amount. But this year you're in the top marginal bracket, but you know, next year you won't be. You'd put it off till next year. Otherwise, just giving the government money for nothing, and they don't spend it very well.
Yeah. No, that makes sense. Thanks for that. Yeah.
Yeah, no worries.
All right. I'm happy to stop the recording in a minute. If anyone did desperately want to stay and talk to Jesse, something that they didn't want to be recorded, that's fine. I'll hang on the line with Jesse for a couple of minutes. But just to wrap up, thanks for your time today, Jesse. Much appreciated. That was really informative. I've run a few businesses myself and I've got one going. I've still made myself some notes of things I think, shit, I need to double check that. Shit, I need to double check that. And I will be going and asking my accountant those questions tomorrow. So yeah, once again, we genuinely appreciate your time. Matt, Steve, and Ian, just so you know, and anybody watching the recording later, Jesse does that in his own time for us as a veteran-owned business. We support him. It's BBS Tax. If you're watching or listening to the recording, you want to reach out to him, and you can, go for it, go direct. If for any reason you don't think you can, you want to come through me, drop me a note, let me know, and I'll happily pass you on to Jesse and make the connection for you. So on behalf of Frontline Labs and all the people attending and watching, thanks very much, Jesse. Appreciate your time.
No worries. Thanks you.
Awesome.
Thanks, Jesse.